thumbs up. Thank you very
Yes,
much.
I can hear you.
All right, thank you very much. So class is officially in session. Welcome to a riveting, action-packed 1 hour on home equity conversion mortgages. Just a short little bit about me. I am on year 40 as a mortgage loan officer. I have been a CE instructor for the last 15 years. I teach classes all over the United States. This particular class I've taught from Georgia to Maui. I've taught it over 250 times. I've been in front of thousands of real estate agents explaining how a home equity conversion mortgage works. So I want to go over just a couple of parameters. First of all, the old-fashioned word, the slang word, the word you don't want to use is reverse mortgage. All right. There's so much misinformation out there that has never been true about it, that we always use home equity conversion mortgage, or HECM, with the idea of keeping the people neutral long enough so we can get them accurate information to be able to make an educated decision. This refinance product has been around since Ronald Reagan. It's nothing new. The problem is most people just don't understand of it, so consequently they're scared of it. So just real quick, there's this misinformation, I refer to it as fake news out there, that if you take this loan out, you're signing over your house, your title, and your equity to the bank. There'll be nothing left at the end. That has never been true. The vesting on this loan works the same as any other loan. The customer is put on title, the lender puts a lien on it, the customer can sell the house and or pay off the loan, and the remaining equity goes to the client or the heirs. So the titling and the vesting works just the same as any other loan. So that has never been true. All right. And so 75% of the net worth of seniors out there in the United States is the equity in their primary residence. The problem is home equity is not liquid. There's only two ways to get at it: sell it, which is the purchase class, or borrow against it, that we're going to talk about today. And so the problem with borrowing against it, and this loan is built specifically for seniors, if you're not 62, you can't have it. And FHA rolled this program out to be able to help seniors better be able to monetize the equity in their home, plug it back into a proper retirement strategy to help them be able to keep their home longer. The number one fear of seniors in retirement is running out of money. It's not death. They can plan for when they're going to die, but what they don't know is how long they're going to live. And when I'm talking with seniors and we're talking about retirement and financial planning and etc., do you know what the recurring theme is that I hear? Gee, if I'd have known I was going to live this long, I'd have taken better care of myself, is the recurring conversation that I have with these seniors. And very often the difference between retirement success and retirement failure is the proper monetization of their greatest asset, which is the equity in their home. There are currently 75 million baby boomers out there in the United States. A baby boomer is defined as somebody born between 1945 and 1964, and they are turning 62 at the rate of over 10,000 people a day. So there's a huge demand for this particular financial product. The problem is most seniors either don't know about it or they don't understand it. The average Social Security income out there is about $1,800. And the average retirement account that seniors have when they retire has about $100,000 in it. Try retiring on that, okay? Try living on $1,800 a month Social Security. Do you know what you call a baby boomer living on Social Security? Broke. The typical answers I hear are broke, poor, and scared. All right. And so very often the difference between retirement success and retirement failure is their proper monetization of their greatest asset, which is the equity in their home. We typically see three sources of income out there for seniors in retirement: Social Security and pensions, IRAs and 401ks, and home equity that we're going to talk about today. The problem is home equity has never been properly monetized or figured out as part of a retirement strategy. And I'm going to make a bold statement because this is a regular FHA loan. It's a regular government loan product built specifically for seniors, and it took some time, but the government finally got it right. And they've now got this managed and tweaked to the point to where it now makes a huge impact. I've closed 500 of these particular transactions over the years. I've closed thousands of mortgages in my 40 years, and I've never closed a loan that had more immediate or long-term financial benefit to a client than what we're going to talk about today. In aging study after aging study, the #1 fear of seniors in retirement is running out of money. And so, you know, when we talk about retirement strategies and IRAs and 401ks, and let's talk about that for a minute. Typically, when you have a retirement account, you're working, you're making money, you're putting it into some kind of retirement account. So when you retire, you turn around and are able to draw that money out. A normal type retirement strategy. But what's interesting is if you put a roof on top of that, and you happen to live in that investment, people go, oh my God, I would never do that. And I'm like, really? You're going to take the largest financial asset you have and you're going to ignore it because you sleep in it? What a terrible financial mistake. We have got to stop ignoring our greatest asset and start properly incorporating it into a retirement strategy. And when done correctly, it is literally life-changing for these seniors. And when I close these loans for these seniors, you know what they typically say? It feels like I won the lottery. How would you like to provide a winning lottery ticket every time you closed a customer's transaction? That's what I get to do for a living because it is literally that financially impactful for them. So your advantages of a Hecm Refinance. We're going to talk first of all about the most common profile that I see. Let's go back 10 years. Customer's 70 years old, they buy a home and they put it on a 30-year conventional loan, all right? And they've only got mortgage payments till they're 100 years old. And by the way, the word for mortgage is French. It stands for death pledge, all right? It literally means mortgage payments till death. So now we're going to fast forward 10 years. They're now 80 years old, all right? They bought this house, they put that money down, they've paid on it for 10 years. Value's gone up, balance has gone down. They now have 60% equity in the property. The problem is that 60% equity does them no good because they've still got 20 years left on their mortgage until they come and take out a home equity conversion mortgage. And you do that refinance and you eliminate that principal and interest payment and change their lives. Because many seniors, what they tell me, if I was on Social Security and I didn't have a mortgage payment, I could live comfortably. So very often the difference between retirement success and retirement failure is not having or eliminating a mortgage payment. It takes an asset which isn't liquid, the equity in your house, and converts it into one that is. One of the options is a guaranteed monthly income stream back. And I tell people, just look at your home equity as any other asset. If you paid into it for 30 years as a retirement account, the idea is why wouldn't you draw that out when you needed it? This is the same idea. It just happens to be the equity in your house. The advantage of this loan is when you draw it out, it's tax-free, payment-free funds. People literally sleep in a Roth IRA and they don't even know it. It's a great way to eliminate spend down of the other assets that they have because they don't have a mortgage payment. It's a great way to protect the asset. It's a great way to help manage their longevity. The gee, if I'd have known I was going to live this long, I'd have taken better care of myself is a real conversation that we have. The tax-free income thing is absolutely huge, by the way, and what a great way to draw some of the equity out and pay off other debts as well. This is my personal slide. About 6 years ago, I made the mistake of letting my wife read the real estate section in the Saturday newspaper, and shortly thereafter, I moved. Happy wife, happy life, right? And so I bought this house in my mid-50s, put it on a normal conventional loan, and had a plan. And here I am down the road with my idea of, I tell people I had no intention of ever paying off my house, and I had no intention of having a payment either with the plan that I just mentioned. Buy the house in my 50s, put it on a conventional loan, value goes up, balance goes down, do a Hecm refinance, eliminate the payment. And so the advantage of that is, instead of trying to have me dump all this money down on a mortgage so that I don't have a payment, I have that money invested in other accounts that's liquid, accessible, and not subject to a downturn in the real estate market. And it completely changes the financial planning retirement strategy. The reason people want a paid off house is so they don't have a payment. Well, when I can do that for them with this loan, then they have a great problem. What do they do with the rest of the money? And when that money is properly plugged into a retirement strategy, it is literally a life-changing event for them. There is a plethora of ways that the equity can be monetized and plugged back into a retirement strategy. Number one is a lump sum, which is, first of all, the purchase, where how much money do I have to put down so I don't have a payment, separate class. Or when does my equity position get to the point that I can do a refinance and pay off my conventional loan and eliminate my payment? There are also income streams and line of credit options that we'll talk about today. So the lump sum is your one-shot deal. What do I have to do so I can get out from under my mortgage payment? This is Sharon. Isn't she cute? When I took this picture, this was a close client of mine. She was 77 years old. She came in after we closed her loan, and I got to tell her one of my all-time favorite sayings, which is, Sharon, I promise you won't miss your mortgage payment a bit. Doesn't she look great for 77 years old? This is her personal slide. And I want you to follow along with me so you can see how impactful it is to take out a home equity conversion mortgage, pay off somebody's mortgage payment, and the impact that it has. When I met her, she was 77 years old. And many seniors, unfortunately, when they retire, what do? They refinance their conventional loan, stretch it out into a 30-year to get the payment as low as they can, and absolutely guarantees them mortgage payments till death. Well, Sharon was 77 years old. She only had 25 years left on her mortgage. All right. She only has mortgage payments till she's 102 years old. Her total Social Security income, $1,800 a month. Not too bad until you see her $1,300 a month mortgage payment. She's literally living on $500 a month. She's broke. She's scared. She's worried she won't be able to live in her house. And fortunately for her, her best friend happened to be a real estate agent. So we looked at doing a refinance for her. Her house appraised at $427,000. The home equity conversion mortgage would loan $261,000. Her current mortgage balance was $222,000. Her principal and interest payment was $1,000 a month. Gone. Well, when you take somebody on a fixed income of $1,800 a month and you take $1,000 a month out of their budget, it is literally a life-changing event for them, for the impact that they have. The nice thing on a refinance is, if the equity is there, you can pay for the closing costs out of the loan. And when we're figuring out time, value, money, a break even on a refinance, we say, how much are you saving? Divided into how much is it going to cost to see what our break even is. Well, in Sharon's case, I saved her $1,000 a month. Her closing costs were $15,000. Her break even was 15 months. Her loan amount started off at $237,000. That is the payoff of her current loan and the closing costs. But we could loan her $261,000. That remaining difference goes into a line of credit that she can draw on at any time for any reason, tax-free, payment-free funds. So we eliminated $1,000 a month out of her budget by eliminating her payment, gave her $24,000 in liquidity. She can use that $24,000 to pay her property taxes and her homeowners insurance, probably for her life expectancy. And she now literally has to eat and keep the lights on, and she has money left over to enjoy her retirement. FHA has us use 4% for an appreciation rate for a projection for the house. That is the long-term national historic average for real estate appreciation in the United States. So there is a track record for that. Down here, years and age going by. Here's the mortgage insurance cost for the year. Here's the interest cost for the year. You add those two together. Here's how the loan balance goes up because the interest is accruing. Here's the property value going up at the 4% factor. How do we determine equity? We take the value of the house minus the balance of the loan. The equity position is still increasing. It's just not increasing as fast because she's not making a payment. And I get to ask her, what are you doing with the $1,000 a month in mortgage payments you're not making? Best problem ever, by the way. And if she lived 10 years into her mid-80s, there's a $340,000 balance on a $640,000 house, and there's about $300,000 in equity left for the heirs. People think that this is an all or nothing. This is just an equity split. They're going to use about half the equity typically so they don't have to make payments. They're going to leave the other half for the heirs. Keep in mind, they still own the house. They're still on title. The equity is always theirs. This is the most common profile that we see and that we work with. A 10-year payment is a lifetime monthly income stream. All right, it's based on age and equity, so each one of them is a little bit different. This is a customer we closed in Hawaii. I swear everybody in Hawaii has a paid off house and is broke. It's not cheap over there, by the way, to be able to live. So this 70-year-old customer had a $500,000 house paid off. His total Social Security income was $2,000 a month. He was barely getting by. So he set this up as a guaranteed monthly income stream. By the way, the 10-year payment, TENURE, the guaranteed monthly income stream is guaranteed out to age 150. Good luck. So in other words, you take it out, it's good for life. In this case, his guaranteed income stream was $1,162 a month, tax-free, payment-free funds. He got over a 50% tax-free raise just by properly monetizing the largest asset in his house, which is the equity in his house. And so we set this up, and he's 70, and let's say he lives out to his life expectancy at age 80. Here is your loan balance increasing over time as he draws out the payments and the interest accrues. And if he passes away in 10 years, we have a $240,000 balance on a $740,000 house. And there's $500,000 in equity left for the heirs. So what a great way to monetize some of the equity in the property so it can be properly used to help them stay in their house. And you do not have to sell the house, by the way. The key here is just an exit strategy to pay off the loan. Put the kids on title, have one of them move into it. He does live in Hawaii, and just do a conventional loan, pay it off, and keep it. All right. The key here is when I tell people it's not like, okay, when your parents die, that FHA's at the door and wants the keys. You have 6 months with 2 90-day extensions. There's plenty of time. So the key is, what is the exit strategy for the family? That's the important part here that needs to be considered is, okay, what's the exit strategy? Unfortunately, many times the parents will take this loan out and not tell the kids, and then the parents die. Well, any loan that the children find out about on the parents' house after they've died, it's a bad loan every single time. So we want to make sure that that the family knows so they have plenty of time to figure out the proper exit strategy. But this particular customer, he wants a raise. Don't we all want a raise? And instead of taking it out for the rest of his life, he sets it up on 120 months his life expectancy, and his income stream doubled. And instead of getting $1,160 a month, he now gets $2,000 a month guaranteed for 120 months. And he just monetized more of the equity sooner, doubled his income tax-free. All right. When you live in Hawaii, you can actually afford to do some things. And so all the loan enables them to do is set it up as a guaranteed monthly income stream. It's tax-free. You don't have to pay taxes on it. You don't have to make payments on it. What a great way to monetize the equity and create it as an income stream. People pay all their whole life on a 30-year loan, paying this money in. They think, why do they need a paid off house? Why do people want a paid off house? So they don't have a payment, but then they stop. And I'm like, if that money was sitting in a retirement account, you wouldn't think twice about drawing that money out. You sleep in a Roth IRA conceptually. So why not set this up as an income stream back? It's very creative. I have not seen a financial problem I couldn't fix if the equity was there. A line of credit is my personal favorite. Do you know when the best time is to set up a line of credit? When you don't need the money. All right. So this is my personal favorite as far as providing the most flexibility for a senior to help them be able to stay in their house. Listen to me very carefully. You will never see this on any other financial instrument ever, especially in real estate. Any money available in the line of credit grows at the interest rate of the loan indefinitely as long as one of you lives in the house. So what a great investment account that enables you to monetize, for most people, their greatest asset, the equity in their house, and be able to use that as part of a retirement strategy down the road when they need it. Follow along here closely. This is my personal slide. I took out a home equity conversion mortgage line of credit last year on my house. And I tell people, why would a 40-year finance guy with a paid off house, perfect credit, no debt, and 7 figures in net worth take out a home equity conversion mortgage line of credit on his house? And the answer is they're just too good a deal to pass up. And I'm a little bit older than my wife, and for the last few years I've been telling my wife I've been waiting for her to turn 62, and I'm like, hurry up, we need to do this. Wasn't the greatest marital conversations we ever had, but she finally turned 62 and boom, we executed our own. And I want you to follow along. This is the best kept secret in real estate finance by far. Very powerful when used as part of a retirement strategy. My house appraised at $785,000. It's paid off. All right. Loan amount that they would loan right at $300,000. Took out the closing costs. My net line of credit is $275,000. And I don't need the money. All right. As I said, the best time to set up a line of credit is when you don't need the money. So I set this up just over a year ago. Down here, years in age going by. All the loan balances is your closing costs. I just paid for my closing costs out of the equity that was in it. Notice how my line of credit grows. The money in the line of credit grows at the interest rate of the loan. In the last 50 years, the average mortgage interest rate has been about 7%. Guess what they're at right now? About 7%. All right. And that's what this projection is at, is about 7%. And so the rule of 72, this is something financial planners use. You take the interest rate you're earning on your investment and plug it into that. And so at 6%, it takes 12 years for your investment to double. At 8 years, it takes about 9. At 8%, it takes about 9 years. At 7%, it will double in about 10 years. So I set up this line of credit. I don't need the money. I let it grow. And in 10 years, it's $500,000. The problem with a regular bank HELOC, They put them on 10-year terms, they close them or call them, or convert them to an income stream. They're actually predatory for seniors. And a lot of seniors don't know this, but a bank can close their HELOC anytime they want. So don't ever think if you set it up that you're set, because if they're not comfortable with you or the real estate market, they can pull the plug and close them anytime that they want. So I have this set up. I let it grow. I'm now down into my mid 70s, and I'm hoping my health holds, and I'm still doing fine. And we go out a little over another 10 years, and I'm now getting into my early 80s, and it is now grown to $1 million. So would I spend $24,000 of my equity for $1 million in tax-free, payment-free funds in my 80s? Who said I didn't win a winning lottery ticket? All right. All I'm doing is monetizing the equity in my house for a future event. This is the best kept secret in real estate finance. People have no idea. All right. And you can set this up, let it grow. And this $1 million, when it gets here, I can draw this out any way I want. So what a great way to monetize the equity in the property for a future event. Anybody checked on the cost of long-term care insurance? All right. 70% of us will need some kind of long-term care before we die. 90% of us have no insurance. It is one of the greatest financial gaps and worries that financial planners have. I self-insured. You'll be shocked to know this with long-term care insurance. They don't want to pay the claim. Yes.
Yeah, we have a question from Rebecca Kramer. Prepayment penalties, can you do this more than once depending on changing circumstances?
Yes, you can have more than one of these. You just can't have more than one at a time because it has to be your primary residence. So I've set these up, circumstances change, they've sold the house and they've done it on their next one. So yes, you can have more than one, you just can't have more than one at a time. Good question.
All right.
Thank you.
Thank you. And she also says, please address the mortgage insurance.
Coming up, upcoming slide.
All right.
All right. So this is a great way to monetize the equity. And the nice thing is future home value has nothing to do with the terms of the note. The money in the line of credit grows on the interest rate of the loan. The value of the property has nothing to do with this. Also, it's a non-recourse loan, which means if the loan ever gets upside down, the bank, the lender, the government can't go after the client, the heirs, the estate, or any of their assets. They can't go after anybody or anything. So an interesting number, 80% of men in this country will die married. 80% of women will die single. There is your current math. So we set this up and let it grow. And you know, my wife has an interesting hobby. She likes horses. You know, and you got to have two. What if one goes lame, right? You always got to have two. Guess what my greatest monthly expense is? Equine therapy. Best money I ever spent, right? Happy wife, happy life. And so she has a ladies group that she's in every month, and there's about 8 of them. Surprising, right? Half of them are widows. She has lunch the other day and they're like, what are you going to do when Curtis dies? And I'm like, hello? They're like, you going to get another husband? And they're like, no, I'm going to get another horse, right? So I've passed away in here. Her equine therapy kicks in. I've set her up. I've protected the house. I've protected her. And financially, she's taken care of in the event of my unfortunate demise when the time comes. And so she does that. And she lives down here into her mid 90s. And the line of credit doubled again. It's now $2 million. So she's in her mid 90s and she has a $2 million line of credit. All right. You know, we had a teenage son at home named Noah. We must have done a really good job raising him because he knows absolutely everything. Right. Anybody else have one of those, right? You know, and one thing our son Noah is really good at, a 100% success rate at, cashing our checks. He's perfect every single time. Count on him every time to do that. So we get down here. I've passed away. My wife's in her mid 90s, and she has a $2 million line of credit, and the house is only worth 1.5 million. Been a market correction in 2008, and the value of the house is less than the money in the line of credit. FHA can't close it. Future home value has nothing to do with the terms of the note. Okay, so she's diagnosed with a terminal illness. She has 90 days left to live. What does she do for our son Noah? Cut him a check. Got 100% success rate at him cashing him every time. And the nice thing is, because it's part of the estate, it's tax-free to him. And because it's borrowed funds, it's tax-free to us. What a great way to protect the estate, protect your children, and ensure that there's more money left over for them, not less, in the event of a real estate downturn. And so we get down here, we execute this strategy. She draws out the 2 million. Here's the money that's owed. We'll round this up, say there's $2.2 million owed on a $1.5 million house, and she passes away. Noah has $2 million in tax-free money sitting in the bank, and he signs the house over to FHA, and the $700,000 in short sale amount, the FHA mortgage insurance pays. It's short sale insurance that everybody pays into because it's a non-recourse loan, so that if the loan ever gets upside down, they can't go after anybody or anything, and the FHA mortgage insurance pays it. Best insurance you'll ever buy. So we execute this strategy, but knowing my son Noah, after we've passed away, he'll decide he'd rather keep our house, which FHA says he can buy for 95% of current appraised value. Well, the house is worth 1.5 million. 95% of that is 1,425,000, and he buys the house out from FHA with the money we gifted him off the line of credit before we died. He died. He ends up with our house paid off. He ends up with nearly $600,000 left over, and he will live there happily ever after and never have to worry about money. And not only did we protect us, but we also protected our heirs. Many times when I talk to seniors, they're like, oh my gosh, what about my kids? And I'm like, I do believe Noah's going to get by just fine under this particular scenario. So don't ever think that there won't be anything left for the kids. That is certainly not necessarily the case. This is the same client we talked about in Hawaii. The only thing different is instead of setting it up as an income stream, we took the same exact profile, set it up as a line of credit, let it grow for 10 years, it doubled, then he draws it out. And keep in mind, you can draw these funds out in any form you want, a lump sum, a monthly income stream, whatever you need to do. It's very creative. And don't forget, when you draw the money out, tax-free, payment-free funds. Closing costs. The closing costs are higher on this loan than a regular loan. The main reason, per the earlier question, FHA charges an upfront mortgage insurance premium. It's 2% of the value of the house. And that is the main reason why the closing costs are higher. So on a $500,000 house, it's $10,000. And so that is why the closing costs are higher, but the FHA mortgage insurance funds and helps guarantee the non-recourse feature so that nobody has to worry.
Curtis, excuse me, we
Yes.
have a question from Rebecca. Is a rate assumable?
No, these are not assumable loans. Once the last heir has passed away, They have 6 months with two 90-day extensions to pay it off. There is no way to do these as an assumption. Thank you. So just think of the mortgage insurance as short sale insurance, okay? That's basically what it is. On that is that you have to be able to insure it because, you know, they're doing certain amortization schedules and projections. Underwriting. You know, it's surprisingly easy to qualify for a loan that doesn't have a payment, right? So let's underwrite a file real quick. Let's start with credit. Have you made your payments on time for the last 2 years, including your property taxes, your homeowners insurance, and your HOA if you have one? Yep. Okay, we're done. It's that straightforward. No credit score minimum, nothing. If you've made your payments on time for the last 24 months, then you credit qualify based on the loan. Income, there's no debt ratio, there's no payment. Think VA residual income, okay? We don't work off of, you know, any kind of a debt ratio or payment. So let's underwrite based on income. For a single individual, we need $600 a month left over, all right? FHA charges 14 cents a square foot on paper to live there. So on a 2,000 square foot house, 14 cents a square foot is $280. Let's say taxes and insurance are $320. $320 and $280 is $600 total. Residual income puts us at $1,200. I need a social security statement for $1,200 a month, and we close. It's the most lenient loan in the world. You got to keep in mind, there's no payments on the product. If you take a poor broke widow on $1,200 a month social security and they go to the bank and the bank makes them a HELOC or a regular conventional loan, do you know what we call it in the business? Predatory lending. You're setting them up to take their house. For a married couple, I need $1,100 left over. So in that case, if the total expense was $600, add $1,100 to it, I need $1,700 a month as a married couple. Typically, Social Security statements satisfy the income requirement, and we move on. What if they don't qualify? We hate it when that happens. You know the most common reason why seniors don't qualify? Delinquent property taxes. All right. After 2008, this loan had nearly a 10% default rate. And I'm like, how do you have a 10% default rate on a loan without a payment? They didn't have the money to pay their property taxes. We didn't used to underwrite. It was age and equity, and we closed. And once they started having defaults, they're like, okay, we need to start underwriting these to make sure they have enough money. And the first thing they look at or want us to look at is how they paid their taxes and insurance. So if they've had delinquent property taxes in the last 24 months, denied. So how do we get around that? Out of the line of credit, we set up an escrow account for the property taxes and insurance. So taxes and insurance, $300 a month, $3,600 a year. Life expectancy is 10 years. We're going to carve $36,000 out of the line of credit to pay their taxes and insurance, and we will close them anyway, even with delinquent credit. FHA's thought process on this is if you don't have a payment to make and the loan pays your taxes and insurance, there's nothing left to default on. You have to literally eat and keep the lights on, and we can close them anyway. And we have customers, you can set that life expectancy set aside, the Lisa up voluntarily. Why wouldn't you have the equity in your house pay you back? All that equity and all, one of the biggest risks that seniors have in retirement is escalating property taxes. Why not use some of that equity to pay the taxes and insurance to help them be able to stay there? So you can even set it up voluntarily. And when I present this particular part of it, and seniors are like, so let me get this straight. I don't have a payment. The equity in my house will pay my taxes and insurance, and I'll be able to live there more comfortably. I'm like, that's exactly how it works. And like, as Clint Eastwood would say, go ahead, make my day. What if they don't qualify on income? I see a lot of poor broke widows. It's heartbreaking that can't even pass residual income. So we can use other assets as an income stream to pass residual income. Take an 80-year-old client out to age 100, 20 years times 12 months, 240 months. They've got 240,000 in retirement accounts. That ends up being $1,000 a month. We'll plug it into the residual income requirement. We pass and we close. So it's very creative, and get this, they may not have a penny in anything. I talked to an 88-year-old client this morning. He has $78 in his checking and $98 in his savings. It is heartbreaking, all right? And to be able to set this loan up, eliminate his payment, set him up with a line of credit is a life-changing event for them. For many of them, it's literally the winning lottery ticket to help them be able to stay in their house longer. And get this, the money available in the line of credit, we can use as asset dissipation to be able to pass and to close. Wow. Loan options, fixed versus ARMs. I haven't closed a fixed in years. Fixeds are a terrible deal. You want an ARM because that's where all your HELOCs and your income streams are. You can't do a fixed on any of those products. And of course, I'm talking to seniors and they're like, well, I don't like ARMs and adjustable rates. They make me nervous. And I'm like, well, why? And they're like, well, my rate could go up. And I'm like, yeah. And they're like, well, if my rate goes up, my payment goes up. And I'm like, you don't have a payment. The paradigm is completely different. The only thing the interest rate affects is the balance of the loan at the end. The appreciation rate of the house has way more impact on the equity position than the interest rate on the loan as well. There are a lot of different financial planning strategies that this loan can be helped. One is everybody I hope knows that every year you defer your Social Security from 62 to 70, you get an 8% raise. Why not set this loan up, help it subsidize your income to help be able to defer your Social Security to be able to get a maximum benefit? Buy a second home with it. This is how, as a realtor, you get a paycheck out of a refinance. Last year, and I've done this a bunch, set that line of credit up, draw some of the money out, and buy a second home or investment property with it. Why not? So, it's a lot easier to qualify for the payment on a second home when you no longer have a payment on your first one. Buy a duplex with it. Do a fourplex with it. Think about what that means when you can set this up, not have a payment, and collect income streams without a payment on it on a duplex or a fourplex. What a great strategy as part of a retirement plan. Gifting, the old broken paradigm with seniors that, they lived in the house, they lived a long, happy life. And then when they passed away, they passed it down to the next generation, typically farmers and ranchers, is so broken. All right. Most of the time now, the kids don't even live in the same state. And the last thing in the world they want is their parents' house. So set that line of credit up, gift it to the kids to buy a house, gift it to the grandkids for college. Why wait until you've passed away and gift them the house when you can set up that line of credit and gift it to them when they need it? It's tax-free, payment-free to you, and set up correctly, it's tax-free to them as well. So what a great way to be able to help advance it when they need it. The problem is when the parents have passed away, the kids are typically in their 60s and a lot of times don't need it anymore. The buying a second home thing is big. All right, or an investment property. So what a great form of leverage. I've done this for realtors who come to class a lot because they understand the importance of leverage and how to monetize that equity and buy additional real estate with it. I want to share a story to give you an idea of how impactful this loan can be. I taught a class in Sun Valley a few years ago. And a few months later, I have a realtor call me up. She calls me and says, Curtis, you've got to help us. We're on the verge of a family crisis. My mother-in-law has run out of money to make her mortgage payments. And she says if we have to sell her house, she's moving in with us. All right. This is a true story. The whole family's in crisis and chaos. They're just throwing a fit. And this lady is mad. She's angry. She's cranky. And she says, and by the way, Curtis, she's got enough money left for one more payment. So let us know when you got this figured out. All right. So this lady is 75 years old, victim of the Social Security death penalty. All right. So let's talk about that for a minute. He makes 1,500 a month. She makes 1,000 a month, and their mortgage payment's 1,000. So they make 2,500 a month. Their mortgage payment's 1,000. They can get by until he dies. Keep in mind, 80% of men in this country die married. 80% of women die single. So he dies. She gets the higher of the two, his, loses hers, and is immediately in financial crisis because they still want that mortgage payment every single month. And that profile is out there in this country by the millions. So what do? She's 75 years old, a widow, total Social Security income, $1,300 a month. Her principal interest PITI mortgage payment, $1,600 a month. She's upside down every single month. I wonder why she went broke. Her house balance, she owes $115,000 on it. Her house is worth $800,000. She has nearly $700,000 in equity in this property, and it's actually sucking her dry every single month as a liability. So what do? I do a refinance. The first thing, her principal and interest payment is $1,000 a month. Gone. Well, when you're on $1,300 a month Social Security and you take $1,000 a month out of somebody's budget, pretty significant, right? In addition to that, we set her up on a 10-year payment, TENURE, a guaranteed monthly income stream, tax-free, of another $1,300, and we put $50,000 in her bank account. We doubled her income tax-free. We eliminated $1,000 a month out of her budget. We put $50,000 in her bank account, and she will live there happily ever after and never have to worry about money again. And I get to do this for a living. Imagine that, 2, 3, 4 times a month. And we did an amortization schedule, and we estimated that based on a long, happy life for her, that there might be about a $500,000 balance on a home worth way over $1 million. And very privately in separate conversations, the daughter-in-law and the mother-in-law both said they would happily pay $500,000 to not live together. The downsides. People always say, well, what are the downsides of this loan? There are two. The closing costs are higher up front, and there's not as much equity in the property in the end because they used some of it. That's it. Those are the downsides to the loan. Final questions, Allie?
No questions, but they're asking if slides are going to be available.
Let me send you this slide deck. Sure. Also, I have videos on how these work. They're an excellent way to start the conversation with family, friends, clients. I have an 8-minute video. It never mentions the word reverse. Rule number 1, you never say the word reverse. I have 2 separate ones, purchase, refi. All right. You can also reach out to me directly. My website is thelendingspot.com. I live in Boise, Idaho. I'm right down the street. So I'll get you the slides, Allie, so that you're welcome to send those out. Also, you're welcome to reach out if you would like the videos to me directly. My contact information is on there, or you can find me at thelendingspot.com. I also teach private classes all over the nation. We're also happy to set up a Zoom class for your brokerage if you find that would be helpful. The videos are a great way to start the conversation. Any other questions?
No, I don't see any questions aside from that. So Yeah, I'll just wait for the copy of the slides, or you can send it over to them if you'd like to.
Okay,
I could send you the
I'll
list
have
of the
those over to
attendees.
you so you can get that out to everybody in class, or we'll
Okay,
get them out to you.
all right, thank you. Sounds
All
good.
right.
Very good class. Hey, thank you very much.
A fascinating financial product for seniors. I can't help it. I got to say it again. The government finally got it right.
Well, good. Well, thank you. And I agree. They finally got it right. And that's why I appreciate you coming on here and sharing what you know, the brokers out here, giving them more tools to help them build their business in these very interesting times to do real estate. Anyway, everybody, hope you have a wonderful day. Be safe out there. Brokers, look out for each other. We're in a relatively safe industry, but there's always that 1% out there. So when you go out and show houses, make sure you reach out to your colleagues or your family, let them know where you're at, and follow your instincts. If something doesn't feel right, if someone doesn't feel right, listen to it. Be safe out there. Uh, Curtis, Allie, very good. Talk
Thank
to
right.
you. Thank you, Fred. Thank
talk
you,
to you
Bye-bye.
later.
Curtis. That
Bye bye.
was a great class. And thank you, everyone.
All right.
We have
Thanks
another
again.
class tomorrow if you'd like to.
Thank you,
Yeah, just
everyone.
feel free to let me know if you'd like to grab a spot. Thank you.